Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. It is Diwali time and festive spirit is in the air. It is also that time of the year when every stock market expert worth his salt doles out his favorite Diwali picks. And nothing wrong with this in my view. Any sensible and genuine help to the retail investor is always welcome. However, my goal in this video is not to share my own Diwali picks. It is to share something far more useful, something that has had a huge influence on my own investing thought process, and I believe will do the same for you. It's a stock picking advice that could have a positive impact on your long-term returns if you are disciplined in implementing it. So let's check out what this advice is all about. Well, the starting point of today's discussion is an old YouTube video of mine. Concerned with the relentless rise in IRCTC's share price, I came out with a video on the stock a year ago. Although I had only a basic understanding of the company's business back then, it was the valuations that were giving me the jitters. Based on its normalized earnings, the stock was commanding a huge PE multiple in the region of 100x. I don't think there are many stocks that you buy at a PE of 100x and end up making good money over the next 3 to 5 years. However, my advice and those of other like-minded investors continued to fall on deaf ears. The stock kept going higher, and within a couple of weeks of my video, the stock was up another 44%. I hope investors who ignored the valuations and kept buying it were able to sell at the top. If they have not, they missed a golden opportunity in my view. The stock is down more than 40% from its 52-week highs, and it doesn't look like it will scale those highs again anytime soon. IRCTC is not the only stock that has suffered this fate. A couple of other investor favorites are the so-called multi-bagger stocks like IEX, Indian Energy Exchange, and Dr. Lal PathLabs find themselves in a similar situation. Both saw their stock prices being taken to multi-year highs with little or no regards to valuation, and both have been taken to the cleaners in the last 1 year or so. In fact, in the case of IEX Limited, the decline has been more than 50%. Any investor who made the mistake of investing at the top, he is certainly staring down a deep, dark alley. In case you are wondering how it came to this, well, a large part of the blame must be laid at the doors of human greed. When the greed of making a quick buck dulls your senses, no PE is high enough. Your mind keeps concocting new reasons to keep taking the PE higher and higher. I think Ben Graham has put it quite well in his fantastic book Security Analysis. Here's what he has observed. The notion that the desirability of a common stock was entirely independent of its price seems incredibly absurd. Yet, the New Era theory led directly to this thesis. If a stock was selling at 35 times its maximum recorded earnings instead of 10 times its average earnings, which was the pre-boom standard, the conclusion to be drawn was not that the stock was now too high, but merely that the standard of value had been raised. Instead of judging the market price by established standards of value, the New Era based its standards of value upon the market price. Well, here's the crux of what Graham is trying to say. The greedy Mr. Market is a brilliant salesman. If you have no idea how much you're willing to pay for a company, the glib salesman that he is, Mr. Market will convince you to buy the stock at any PE multiple. He will keep on concocting these wonderful stories and assure you that the multiple you are paying is not very high. Therefore, an easy way out of this trap is to fix an upper limit yourself. Decide what is the maximum PE that you would like to pay for a stock and stick to it. You should not budge no matter how good the fundamentals or how promising the growth of the underlying stock. My own experience and the way the Indian stock markets have worked historically tells me that this upper limit should not be more than 25 to 30 times for Indian stocks. If you consistently keep paying more than 30 times in the name of quality or high growth, I don't think you will end up with market beating returns over the long term. Now take a look at all the 3 stocks that we are discussing today. All of them are trading at a PE of more than 30 times my upper limit based on my own experience. In fact, the lowest amongst them is IEX, which is trading at a PE of 40x, with the average of all the 3 stocks being more than 60x. Now here's what happens if you create a portfolio of 30 stocks where the lowest PE is 40x. This is a portfolio of some of the best growth stocks created back in December 2017. It has some very good names like Dixon Technologies, Berger Paints, Relaxo, etc. However, as a group, this portfolio gave only 10% CAGR for a 3-year period between December 2017 and December 2020. Now, as you can see in this table, this 10% CAGR was even below what the Sensex earned during the same period. Sensex gave 12% CAGR while this 30 stock portfolio gave only 10%. Now, this table is one of the big reasons why this portfolio performed poorly. The average PE of this portfolio back in December 2017 was a huge 64.6 times, as you can see at the bottom of the table. The minimum PE was 40x, the same that IEX is trading at currently. The maximum PE was almost 120x, commanded by Avenue Supermarts. Look at the list of stocks. It has some of the best growth as well as quality stocks of the past few years. And still the portfolio underperformed the Sensex over a 3-year period because I think the valuations were very high. It goes back to the same point that you should have a reasonable upper limit that you should be willing to pay to any stock, no matter how exciting the growth prospects or how good the quality. Now here's something very interesting. Let's take the same 30 stocks but change the starting point from December 2017 to March 2020. March 2020, this was right after the market collapse due to the coronavirus pandemic and when the PE of these stocks must have also fallen quite a bit. Here's the individual and the average PE of the same 30 stocks in March 2020. As you can see, the average PE has fallen to below 40x from a huge 65x, thus making the portfolio much more attractive in valuation terms. Here's the performance of the same 30 stocks between March 2020 and now, that is October 2022. As you can see, the same portfolio of 30 stocks has put in a stellar performance, earning a CAGR of more than 50% between March 2020 and October 2022. Look at the return some of the individual stocks have given. APL Apollo Tubes multiplied 9 times. Action Construction gave an 8x returns. Shelly Engineering also similar. Then there are stocks that are up 6 times, 5 times and 3 times. In fact, there is only one loser, Whirlpool, down by a CAGR of 5.5%. Is this better than the Sensex? You bet this is. The Sensex has returned 30% CAGR during the same period, whereas our portfolio has earned 53%. Therefore, our portfolio has outperformed the Sensex by a big margin. Here's the comparison between the two portfolios. The same 30 stock portfolio returned only 10% CAGR between December 17 and December 2020, when the average PE of the group was 64.6 times, whereas when the average PE fell to under 40x in March 2020, the same group gave an impressive CAGR of 53% and even outperformed the benchmark index by a big margin. Now, many of you may accuse me of cherry picking both the dates as well as the stocks in the portfolio, and I don't blame you. It does look as if I cherry picked the data to suit my theory. However, I am quite confident that if you conduct a similar study across other time periods and for a different portfolio of stocks, there is a strong chance you will also get similar results. In fact, most famous value investors will also tell you the same thing. Avoid paying a very high PE multiple to a stock, especially if your time horizon is 2 to 3 years. Fix an upper limit and do not go beyond this limit. Of course, it's a different matter if you believe that you are highly skilled and can figure out in advance whether few stocks are worth buying even at a PE of 50x or 60x. If you know the underlying business quite well and are confident that these stocks will give good returns after 2 to 3 years, even after paying very high PE multiples, then please go ahead and buy them. But please note that there is a very thin line between confidence and overconfidence, and therefore it is always better to be conservative when it comes to matters of valuation. I'm sure investors who would have bought into stocks like Dr. Lal Path Labs or IEX Limited a year back may have done their homework and considered themselves to be an expert on these companies. However, even the most in-depth analysis cannot prepare you for the kind of disruptions these businesses seem to be facing right now. Both the businesses, considered market leaders in their respective fields, are now likely to witness a much higher competition intensity, thus putting a big question mark over their future profitability. And this is precisely the danger with paying a very high PE multiple for a stock. Since so much of expectation is already priced into the stock, a small whiff of trouble and investors get jittery and start dumping the stock. Hence, on account of these downside risks, it is always better to be conservative and incorporate a sufficient margin of safety into the multiple that you are willing to pay. Now, to answer the question we asked in the title, when will these stocks recover? Well, the key lies in minimizing your risk and not trying to maximize your upside. First, you will have to decide what is the maximum PE multiple that you are willing to pay for these stocks, and mind you better be conservative here. Secondly, if you've bought these stocks closer to their all-time highs, then you can perhaps average out at or below the PE multiple that you fixed for these stocks. While doing this, you must be mindful that you don't make any one stock more than 5% to 6% of your entire portfolio. Now, all you have to do is sit back and track the fundamentals. If they improve, the price will also move up, hopefully making you a good profit. And if they don't, you may have to bite the bullet and exit these counters. The good thing here is that you now have a proper framework of investing, a framework that limits your losses if you are wrong and rewards you with a good upside if you are right. Without a proper framework and without any idea of the maximum multiple you should pay for a stock, you would be lost and may even end up making huge irreversible losses. So beware of this mistake, and I'm sure your investment journey will look a whole lot better. So that was the advice I wanted to share with you today. Hope you found it useful. That's all from me today. Please do not hesitate to like and comment on the video if you found it useful. But before I leave, here's wishing all of you a very happy Diwali and a prosperous new year. I'll see you again next time. Goodbye and take care.